All good things come to an end, and I don't know whether I can use the word crescendo, but I must say every panel has been well moderated, participants very engaging, very honest. The topics have been well chosen, so this is probably the best time for me to thank all the team at Event Rock for organizing this event. I don't know whether we'll ever go back to normal events or whatever they were before this time, and obviously the team with Justin who have enabled this to happen. Our last panel is again another exciting topic. The moderator today will be Tim Smith. Tim from Hazeltree is, I actually happen to be on the preparatory notes of this one, so I'm particularly looking forward to the engagement. Tim, the floor is yours.
Thank you very much indeed, Gabrielle, and good afternoon and good evening, everyone, and thank you for joining the last panel of the day and on the future of tech in securities finance. And as Gabrielle said, yes, my name is Tim Smith from Hazeltree Treasury and Portfolio Finance Services. Technology has been a sort of a driving force in securities lending for at least 40 years. In many instances, it can sometimes seem that it is the cart leading the horse. However, this is not really true as regulation, multiple routes to market, new instruments, and even the actual changing securities finance ecosystem, its structure, the ways of doing business have all pushed those boundaries and have framed the approach, as we've heard in earlier panels today. They've pushed the fintech companies to develop their future tech offering. Or is it indeed that case? Is it the cart leading the horse or the horse leading the cart? Fintech company development of future technology has been instrumental in market developments, and this looks like set to be continued, as we will hear today. It may have been the thinking actually behind Jamie Dimon's recent quote on CNBC when he said that fintech is the greatest threat to the bank's position. I don't know what he quite meant by that, but no doubt we will perhaps delve into that sort of area in the next hour or so. So we're going to examine the future of tech and securities finance world through the eyes of market stakeholders that we have arranged today. And to this end, I'm joined by 5 experts in their respective fields with multiple years of experience, all with their eyes to the future, who I will now introduce. Firstly, we have Matt Wolf, who leads the strategy and development of OCC stock loan program, which is the largest securities lending clearinghouse in the world, with daily loan balances averaging over 115 billion US dollars. Matt has been an advocate for innovation for well over a decade at the OCC. He currently is leading an effort to rebuild OCC's clearing platform using DLT, which is obviously one of the main topics we're going to be covering today, and working with the industry and the SEC on a set of program enhancements. We also have Phil Morgan, who's the CEO of Pyram, 20 years previous experience on the buy and sell side in trading, collateral management, and risk management. So that's going to be a very good overview. We have David Lewis, Senior Director of Securities, Derivatives and Tax at FIS. More than 25 years in securities finance and collateral with various banks as well as technology companies. And David now runs the global market data business, Aztec Analytics. We heard in previous panels a lot about data and what's that going to do for the future. Mike McCauley is Managing Director and Global Head of Product Development and Strategy for BNY Mellon's Securities Finance business. He's responsible for leading the business's efforts to identify and capitalize on new opportunities in a changing business, regulatory, and technically driven environment. Okay, so that's going to be key to hear from Mike on that. And finally, but not least, of course, Armeet Sandhu, the CEO of Stonewayne. All of you seem to have a remarkable 25 years, apart from the youngster Matt, who has only about 10. But Armeet has 25 years in securities finance, focused on pragmatic solutions for current issues while keeping a keen eye on future transformations, which is a very good segue into what we want to talk about today. So that is your panel, ladies and gentlemen, and we're going to kick off in a sort of like a scene-setting discussion about the future of tech and to allow everyone to set their stall out, as it were. I mean, isn't every stakeholder firm within securities finance or even capital markets as a whole a financial technology company in some form? Perhaps that's where Jamie Dimon was going. Do fintech groups lead or mold or respond to that business, that future tech business? And what are the banks and brokers doing today that might point the way of the future direction? And what are the drivers to the future tech? Now, that's a long question, but I wanted to give a sort of the ability for these guys to spread their wings, because they know what they're talking about. So we'll lead off, Mike, if we may, with your good self.
Thanks, Tim. Interesting questions, and I think we can have a robust discussion about those. I mean, just the question of what is a fintech or a financial technology company, or what is digital, is something that we debate internally all the time. I think the connotation is that they tend to be these small disruptive firms. But BNY Mellon, for example, is a large institution. We work with many of the people on this panel to create technology solutions for our clients. And we also develop our own technology internally and through partnerships. I think on one of the previous panels, I think it was Sal, mentioned our partnership with Google and the use of AI to help predict fails in the treasury markets. Then you move into, creating custody for digital assets. So I would certainly consider us to be a financial technology firm. And I think also, when you look at some of the systems and the technology that we use today, many of those were initially developed within large financial firms. So I think, as you pointed out, I think we can kind of view many of us in the financial markets as fintechs. And one of the questions that's come up is do they, do fintechs lead? Do they respond to things? What are some of the drivers? I think it varies. If you look at it through a securities lending sort of lens, what you see is they tend to focus on certain problems. For example, a platform might solve a particular problem that provides a capital benefit or helps in some other way to benefit people who borrow securities. There may be no benefit to the other participants in that value chain, or there may be smaller benefits. But what happens in our marketplace is demand will tend to gravitate, towards that particular platform if in fact it is providing a benefit. So that kind of drags along participation. Certainly as an agent lender, we want to be able to participate in, technology like that, so that we can bring our assets, our client assets, to meet the demands that are created by that technology. In terms of drivers, I sort of think of it in the three phases that, I think we've heard mentioned in different panels, which are really pre-trade, trade, and post-trade. On the pre-trade side, a lot of us have been working on, developing artificial intelligence and predictive analytics to help improve decision making. A lot of technology has been deployed in the trade space in terms of creating and increasing automation in the trading function. But I think the post-trade area is really the one that's ripe for, significant change, and where I would tend to see the trend of increased, fintech providing solutions there. As we all know, securities finance, unlike many other markets, doesn't end at settlement. It's a continuous, requires continuous attention even after settlement. So I think the post-trade environment is where I think a lot of the focus should be. So I'm going to stop there and see if anybody else wants to jump in.
Yeah,
sure.
I think it's pretty good. Oh, sorry. Yeah, I think pretty good coverage there, Mike. I'm not sure what I can add to that, but it was good. That was good. Yeah, I guess from coming from a fintech, what does fintech mean? I think it's a broad church in many ways. You've got the larger if you go back 20 years, when I was kind of, I guess, a market participant rather than a vendor, technology was often viewed as a kind of support function, whereas I think now more so, technology is the business, right? If technology isn't part of your whether it be trading, whether it be collateral management or whatever kind of discipline within sec finance, if technology isn't kind of at the forefront of that, then I think you probably got question marks around the kind of longevity of the business. So I do think there's a range, and I think when people think about fintechs, they often think about disruption and fintechs coming in to disrupt and kind of change the market kind of quickly. I think that still can happen and does happen from time to time. I think from a Pyram perspective, we've been going kind of 20 years, and I would say we've made a kind of, our kind of MO has been to be non-disruptive actually, and to start actually in the kind of non-mission critical areas in the post-trade, to your point, Mike. And then over time, when we've built trust and the ability to kind of innovate and execute, then hopefully, and that's kind of proven over time, institutions trust us to do more kind of mission critical elements such as exposure management, collateral management, reg reporting, etc. So yeah, I definitely think the industry has changed significantly where, Bank of New York, absolutely, Bank of New York Mellon absolutely is now, viewing itself very much as a tech company, as is, other market participants, as well as the fintech. So there's definitely a bit of a kind of, a mixing, as it were, going on at the moment.
Great. David, do you want to opine?
Yeah, I want to jump in there because there's a lot of things flying around about the definition of fintechs and so on. But I want to start with a different definition, actually, following on from your introduction, Tim. I think the definition of an antique is something over 25 years old. So basically, you've introduced a panel of antiques to talk about future technology, which it seems to be a bit old, but hey, here we are. Thinking about the other definitions that have come out, both from Mike and Phil there, I think generally there is a lot of expectation that fintechs are perhaps these small disruptive organizations who deliver what we might call microservices. They're little things that go in and fix a specific issue, as Mike was kind of alluding to. But also, as Phil said, technology nowadays is not a nice to have. It's not an option. Without that technology, you simply cannot exist. It wasn't that long ago that organizations were saying, well, I'm not going to borrow from you, or I'm not going to lend to you unless you have an automated contract compare system, because simply it becomes too manual, too expensive to deal with you. So Phil's absolutely right in that sense. But I think there are very blurred lines between banks and technology companies, as those distinct boundaries are not really there to define those roles as simply as we might want. I read today actually about Amazon launching their financial data services. So immediately I was on that going, okay, Amazon stepping into this area. And a lot of organizations, banks and fintechs are saying, at some point Google or Amazon or someone will come in and go, right, well, I'm going to get into the lending space, or I'm going to get into financial services in that way and revolutionize and really disrupt from a fintech point of view. One of your original questions was in this introduction was, do we lead or do we follow, or do we, do we break the mold? Do we lead the organization? And I think, in fact, Mike used the word drag. So people are perhaps dragged into technology sometimes. But I think it's quite difficult as a fintech provider to be ahead of the industry in some ways, because that's simply a matter of physics, right? It takes a long time to develop things, or it takes a certain amount of time to develop anything. The bigger, the more disruptive things may take longer. So in order for us to, as a fintech, to deliver things that we might consider revolutionary in any reasonable sense of time frame, we've actually got to be way ahead of that particular curve. We've got to be designing and developing things months before the market is kind of thinking in that direction. So fintechs really do have to be in a position where we understand the market, we lead down particular avenues perhaps, because these things take time to create. And I think whilst there's an element of perhaps of, build it and they will come, to quote one of those a film, I think it was. Fintechs are also rational business companies. Anything that we build, we have to go through all the kind of steps that any commercial organization would. What's the business case? What's the market for it? What's
David,
the price?
But I guess they're not all. I mean, I guess a company of your size is, and I guess we, given our kind of age and scale, kind of are. We're further on that journey. But if it's a VC startup, there's lots of them out there. Then I guess they're not though. I think it very, very much depends on what type of, if you've raised capital to create, disruption, then actually you don't actually. So it's real different. There's not one fintech, clearly. Sorry, I've interrupted.
No, there's many different models. I mean, previous panels, HQLAX were on there, and there's been other people on today's sessions that are very much earlier on that path.
But interestingly, with institutions that take that aren't independent, the moment you take funding from market participants, do you potentially lose your independence? That's I mean, arguably you want to stay independent.
I don't know who you could possibly be talking about there, but it's a consideration. Yes. But in a broader sense, it's always been, and I think it always will be, a very symbiotic relationship, and that's why there are people like quite a few of us on this panel and panels earlier today who've had their feet in both parts. For technology companies and banks, I bring the experience I've got from banks and other technologies to the job I do today, and I'm sure you're in your position because of your history in the banks. It's a very blurred line, I think, is a very short answer to this very long question. There's a very blurred line between what fintechs really are and the differential and the role between who's a bank, who's a fintech. Generally speaking, I would always lean to banks do banking and technology companies do technology, but it's quite a blurred line.
I'll just add a couple of points to it.
Yeah, sure. I was going to say, Amit, come in, please.
So the way you look at fintechs in different markets, you have to kind of distinguish, what the behavior of the fintech is, what's its ability to disrupt, and what value it brings to the solution, right? Because at the end of the day, it has to bring value that then unlocks the opportunity. In securities finance, this is a much more collaborative market. It's not as easy to disrupt as you would say, payments over one of these apps to your friends, like a Venmo or something, right? Where you're creating a greenfield system. It does replace something that is there existing, but it's a much more it's a lot easier to make that kind of a disruption because the players and their roles in that market can be disintermediated very quickly. In securities finance, we have to look at fintech as more of a collaborative evolution which benefits everyone. I say that, and people say, well, they have to be winners and losers. Certainly, there are winners and losers, but this is a place where we will get advantages when we move together, which includes the fintech providers, technology companies. A lot of people call Stonewind fintech. I always say we're a technology provider first, and we provide technology to financial services firms. So if that makes us fintech, great. But reality is we are a tech provider. And so we want to focus on that, while there are others here who are either service providers to the market or participants or enablers, right? And I think the uniqueness for us here is to collaborate, to create, utilize future tech, collaborate to create that value and benefit everyone. That's kind of the way I look at it. Mike brought up post-trade. He also mentioned, alpha for pre-trade. And we all can add values in those different segments. And I feel that is something that we have to keep in mind, because that's how we will unlock real efficiencies and value for this industry. Again, like I said, I started this answer with, we have to be cognizant of the space that we are actually operating in, and that's the only way we will create value.
Sounds good. All right, Matt, anything you want to add or?
Yeah, just to touch on, I think I agree with all of you that fintech used to be sort of viewed as a disruptive force, but now, it's very much a collaborative, as Amit just said, or a symbiotic relationship, like David said. It allows people or institutions to focus on their core strengths and leverage the expertise of fintechs where they don't naturally have them. And that expertise can actually enhance your organization's core strength. But one thing I think is important to keep in mind is being highly dependent upon vendors can be a very dangerous position. If you've got a lot of core critical processes being provided by a vendor, you have to sort of ask yourself, what happens if something happens there? What's the switching cost? Is it too high or too long? And think about, would you build in-house? Would you switch to a different vendor? How difficult is that? And does it exceed your organization's risk appetite?
I've got to
I think that's important to keep in mind.
I've got to jump in there, Matt, if I may. As a provider in that space, and as one of my colleagues in the previous panel, Ted mentioned, we're 55 or 57,000 people, a huge organization. And the direction of travel for our banking clients is absolutely in the hosting and managing direction. They're outsourcing these things. And I'm going to jump in with the first mention of COVID on this panel. But if the last year has taught us anything, organizations are much more comfortable with people working remotely. And I understand there's lots of headlines now. I mean, Jamie Dimon, again, let's quote him, has come out today saying, no more Zoom calls, I'm done with them. And I totally get that. There are arguments for lots of different roles and so on being physically in the building. But what I'm saying is that if the last year has taught us anything, it's firms are more comfortable with remote working. And that naturally leads to, well, if I'm not in the same building as my software, then surely that software can be anywhere. And organizations are becoming more comfortable. And indeed, I think it's a reduction in risk in many ways to have that hosted by the people who built it, manage it, run it, develop it, and deliver that product as a service. We're doing a lot of work in the BPaaS environment, or the business process as a service. Our derivatives utility, our software solutions in the whole securities finance suite. People are outsourcing that information and that responsibility.
But I think what David,
but people, hundreds of firms rely on Pyram for their thing. I'm just going to try to actually, I was about to pass the baton to you there, Phil. Absolutely, as a provider in that space who is relied on to do lots of things just like FIS is. So, sorry, Matt, I disagree.
Yeah, I disagree and don't. I'm on the fence somewhat. I think it's an important factor that institutions need to get comfort with. So institutions, as a result, the diligence and the kind of analysis on resilience and contingency, etc., quite rightly, has gone up exponentially over the last few years. So I'm agreeing with David. However, I think the risk element that you're pointing out, Matt, I think is definitely at the forefront of most institutions. We've got a dedicated team now doing the kind of supporting the kind of annual or 6 monthly audit review, etc. So we've seen that dramatically increase because of I guess that's the counterpoint to being comfortable with the kind of outsourcing, and also I guess the necessary building it yourself, which I think was one of the points you raised, Matt. Does that really give you more safety? I'm not so sure. If you're outsourcing to someone who's maybe supporting 120 institutions and therefore has got a very, very robust, resilient, and it's all they do, maybe that's the kind of institution you'd want worrying about it, rather than it being potentially your number 8 on your priority lists as a business. Why would you want to worry about kind of data center or contingency when actually you as a business, is really there to make money fundamentally. So I think definitely where there's, you know, where it's non-differentiating tech, like post-trade, kind of like what Pyram offers, you know, I don't really see why you would want to do that yourself, why you would want to build a reg reporting engine yourself when you can kind of outsource it effectively. And, you know, we've proven that to be the case. Much better put your, you know, finite resources, you know, financial, time, whatever they be, in creating alpha. In my view, I think that's a much better kind of balance.
And
I would say that's
no.
absolutely where the differentiation comes, where the advantage is going to come is how you use these things. But to your point, Phil, relying on firms who do that for a living brings that commonality, brings that support. And I'm going to bring in something Mike said just now in terms of the post trade, and Amit said it as well. Post trade is massively important. Other panels today have been talking about CDM. They've been talking about efficiency, how to get that post-trade process more efficient and a better return for people. Combining those systems, I mean, if we have an organization like us who's delivering that system as a hosted managed service, and you've got multiple clients on the same version with the same connectivity using the same data fields and data formats, connectivity, exchange of information is always going to be easier, better, faster, and more accurate. And it's the fails and the problems in post-trade which create a lot of the cost, right? So
right, yeah,
lots and lots of spin-offs from that.
Yeah, no, that's great, and thank you guys for that opening question has spurred an off of a lot of conversation and discussion. It's great, and I'm pleased you all sort of brought it back to the middle. So when I started by saying, is it the cart leading the horse or the horse leading the cart? I think we've come back to the conclusion it's the horse walking alongside the cart. So which is great, but I think now we can start drilling down into some of the sort of the future tech elements of what is happening, perhaps in slightly more detail. Yes, we've all referenced the earlier panels where they were talking about, you know, AI, machine learning, and all the rest of it. And I guess the first question I have, and it doesn't have to be limited to the sort of examples I give, but, you know, is there ever going to be a time when sort of mark to markets and rate changes are not just systematically settled, but actually predicted? And is that time already here? There was an earlier panel which talked about failure prediction and things like that in the repo market. And is there a much wider application of AI to daily tasks? Dave, do you want to lead off on that one, and then we can get everyone in?
Yeah, okay. And I think I'm sure, in fact, that to a large extent this is already here. It's very much here, and I'm sure Matt's going to follow up with a lot of things they're doing in terms of the way that exists already in his business. Absolutely. I'm going to take really the second half of that question and think more about AI and predictive capabilities. Clearly, Aztec's in that area when we talk about market data within securities finance, but much more broadly in terms of AI, we're putting a great deal of time and effort into that. And forgive me, I'm going to perhaps state something really obvious at the moment. A lot of people probably already know this, but there is a differential between automation and AI. A lot of people perhaps blend that together. Clearly, AI needs automation to exist. It has to have the technical background and connectivity to make that happen, but they're not the same thing. There's lots of processes in the securities finance industry and collateral markets that have already been automated with many clever kind of rules-based and algorithm solutions. But AI is different because it learns and it adapts based on the results that it achieves. Mike mentioned earlier they've partnered with Google AI. We've partnered with C3, one of the biggest AI movers and shakers there is out there, who's helping us on lots of different things within FIS, but specifically in securities finance and collateral. We're talking about how we connect organizations, the connectivity rather, across the whole transaction chain, from the original requirement for collateral or to cover a short and this kind of thing, all the way through to the optimization of matching that demand with the proper supply or the best possible supply, and what we've coined a phrase, kind of the best economic match. And when you have those best matches, you've got lower post-trade costs, you've got a better situation from kind of the most optimum match on T, if you like, on trade date. we can analyze our AI process, really are analyzing the billions of transactions which we've gathered over the years, understanding their outcomes, understanding the decision that was made at the time, in order to support better decision making in the future, based on the counterparty, based on the churn of the funds underneath it, that kind of thing. So AI is going to be huge in the future, I think. And I suppose we're talking about future tech today. AI is absolutely going to be in the future for prediction of mark-to-market rates and things like that.
Excellent. Armi, do you want to chip in on this one?
Definitely. So, a couple of the points that David brings up are very, very important. The data sets that are used for AI are massive, and certainly the organizations that have the access to that data and have the wherewithal to, invest in that AI toolkit will benefit from it. And in our space, there are organizations, securities finance, that have those means, and they'll certainly generate, the returns on investment on it. But then when you start to come to the next part, right, Tim, which you bring up on, things like a rate change or a mark to market, right? It's not good enough that one institution knows what they're doing. We need both the parties, or multiple parties in some cases, if there's a tri-party or a CCP or somebody else involved in the value chain, to kind of get on the same bandwagon, right? So we've got to understand the use of these technologies, where they create alpha opportunities for organizations to actually increase their revenue or increase their share of revenue, and where the same technology then can be used for facilitation and communication, and to make that process much more straight through and seamless. I'll look at rate changes. It's ripe for improvements, because the benefits, just like when we used to have mark-to-market breaks, and now we've made them more and more a thing of the past for at least majority of the straightforward equities processing. Rates are in the same place, right? It's not about rate prediction that's that important. It's about making sure that the rate data is available to all parties, so that when you are re-rated, you're not kind of going through a mechanism of returns and breaks and billing breaks and all the other post-trade problems that come from it. Definitely, I'm less concerned about the ability to predict some of these data points today, as much as I'll focus on David's other parts about having the information to use it for, positioning your firm in the best way possible. I think, the ability to predict prices for tomorrow, if I could do that, I certainly wouldn't be in securities finance. I'd be running a nice fat hedge fund and retired already. So, I kind of look at securities finance sometimes from that perspective. What do you spend on? We have to know what's the return in our industry on it. Yep. So I'll take a pause there.
Okay.
Yeah, I just kind of quickly. Sorry, Mike, go on.
I was just going to jump in and say, back to the mark-to-market thing. I think that was brought into focus, with the events of last March, where we saw, some of the extreme volatility, and, we had equity markets rallying, 11, 12% in a day. And, if you're lending securities against cash at 102, you thought that was a pretty safe endeavor. But that flows over into regulatory calculations. And so even before we get into predicting the marks, I think there's a huge, demand for shortening that time frame of the traditional, next day mark, and creating a way to mark intraday, or to, somehow make that time frame smaller.
Yeah, I totally agree. I mean, I think absolutely. I think the March events did kind of change people's perspective around, what was sufficient, and maybe, how fast markets can move. And I always pick up a point that I think, Armi, you raised in the previous question. In a sense, it's not about technology per se; it's about the process. And I think people are kind of, we talk about DLT, we talk about kind of AI, we talk about. I mean, in a sense, that's just types, that's mediums of expression. Fundamentally, you've got to get down to the process, right? If just having something potentially on DLT is not going to resolve recalls or rate change or marks. It isn't, because it's just a mechanism of another mechanism of settlement, actually. So I actually think that, and this goes to this future tech initiative that we're trying to really push, and we're working with a number of our clients on at the moment. It's actually let's get down to kind of the real issues at hand here, and try and, okay, what is, in many ways what we're offering at Pyram is kind of automation at the edges in many ways, rather than automation of the whole. If we really truly want to revolutionize this process, let's have a conversation about it, and let's engineer reconciliation breaks out. That's kind of, I think, the rather than kind of playing it kind of half ball, as it were, let's go in fully and let's commit to this, and let's really, whether it's CDM or whether it's whatever you're going to call, whatever the name you're going to give it, it's ultimately reviewing and automating the process and kind of potentially revolutionizing it. So in that sense, it could be slightly disruptive, but it's kind of the necessary step that you need to take.
Isn't that really just almost like a straight through processing on steroids and applied to every form of the chain, right? So Absolutely. It's not really a new AI. It's not a new sexy concept of AI.
It's creating an interoperable from Meet's platform to mine, to David's from a data perspective, to to Matt. It's creating and whether one tech firm can do it all, probably not. But through collaboration, I think we can. And I think that's the true kind of quantum leap moment where, we can eliminate wrecks and we can eliminate breaks and we can eliminate, and that, people say, well, Pyram, you wouldn't be in business. Well, I think we would, because we're looking to create the solution, not resolve the issues.
Yeah.
Just because the breaks go away doesn't mean the cause of breaks goes away. So I don't think you'd be out of business, and indeed you pivoted to lots of other
But no, quite. I mean, that's
services anyway. So
that's how I see this. That's where we should be aiming for as a business. That's how I'm trying to pivot how Pyram's being viewed, rather than resolving breaks. No, it's creating STP. That's what we do.
Absolutely, and that's where the collaboration between the different providers in this space will win out in the end, because we're all heading in that same direction, right? There's when you think about all the market participants, from whatever position they take in the transaction chain, they actually have lots of commonality in what they're trying to achieve. And that's going to be efficient operations, low costs, getting all their orders met, getting all their assets lent, getting the best price, whether that's the lender or the borrower, for those assets, and optimizing the best use of that capital, because we're all trying to do more with less, right? So that automation, that connectivity, whether it's CDM, whether it's some other combination of those different mediums or solutions, that's where we need to get to. And I think it's what we've all got on our agenda. And collaboration is going to be one of the ways we're going to get there.
And so, Matt, actually, to the point that you brought about relying on vendors and risk and some of those items, standardization, while it may take away some uniqueness from some providers, is actually will create the mechanisms which enable more players to come in and make life easier for switching and managing your risk and picking the best of breed across the solution providers that are out there. You will see the benefits of folks who specialize and do a good job if you have the ability to then, lack of a better word, move away from the ones that are not being successful. And that's where some of this, is it a common domain model, or if it's blockchain with well understood, generally accepted kind of formats and processes are put in place, I think it makes life easier. And more importantly, from a technology perspective, in technology, we always get blamed for, chasing that shiny new toy, right? Like, it's a new piece of technology and we just all want to jump on it. But at the end of the day, what we got to make sure is those technology pieces that we adopt for securities finance are a fit for securities finance. And I think that's where, in the end, the techs that are going to win are those. The others will, there'll be a lot of investment, but they'll go away.
Beware of the hype cycle.
Yep.
Yeah.
But eventually, you and whoever sent that note, right? The hype and then the reality, and then you get caught sleeping when the reality catches up to you.
I think there's an awful lot of work to be done on the process, as Phil mentioned. There's an awful lot of work to be done on the basic stuff to get it right. And can I just develop one of the things you just said, Army? One of the things that technology is bringing into this space, I think, is a reduction in the barriers to entry, right? So the simpler, the cheaper, the easier it is for market participants to enter this industry, then I think you've got a broader diversification, you get a richer, better market. And to Matt's point, in some ways, you get a reduction in risk because that diversification, that increased involvement and participation, whether that's a fully paid lending program from Robin Hood in the GME kind of way, or organizations such as the large asset managers who are starting to insource a lot of that collateral management and securities finance disciplines. That's partly because the barriers to entry are coming down. And that's because technology is getting better, it's easier to implement. And I'm not harping on about it, but back to the hosted manager kind of thing. Organizations like that are going, well, actually, we can do that ourselves. So I'm going to bring that on board a little bit, and I'm going to employ someone as a tech provider, a fintech, to go and do the heavy lifting for me because that's what they do all day long. I'll become an asset. I'll stay being an asset manager, and I'll improve my processes. I'll improve my processes as an agent lender or a prime broker or a broker dealer, because these barriers to entry are falling, and that's best for everybody because it brings increased competition to the market as well, and it just drives the process even faster.
So, David, I'll follow up on your barriers to entry, and I think this is interesting. And I kind of come back to Tim about all of us being antiques or relics. So I do
not relics. There's a difference between relics, I think.
Yeah. So I do have so I have my son's in school right now, and Tim actually has met him, and these kids in college are doing quant trading models. And we look at this phenomenon of Robinhood, and we look at the phenomenon of retail and the kind of investment strategies that quote unquote retail investors are doing. We'll all know that some of them lost their shirts, and deservedly so. But the futures can be very different, and the lower costs of entry will reduce the barriers for more and more folks to participate. And I think in the long term, it'll generate more net revenue for the industry, and that's going to be very important. What was viewed as the traditional, demand and supply side, we've seen at the institutional level, it's kind of gone away, right? Like people play every side of that game now. More and more people play every side of the game. But now, if you bring in with low cost of entry, you're able to bring in more retail and more diversified kind of trading strategies into play. I think that's great for the industry, and low cost will help. Right? Look at if your cost to do a locate is high, that automatically creates a barrier for certain players to come in. But as an industry, if you're using technology, if we get better, guess what? There'll be more volume. So while margins will be squeezed, and we know every industry is going through squeezed margins, that's just the way of life in what we live in. But I think the barriers getting reduced will be healthier for us as an industry.
Okay, I'm going to move on there because we've got actually quite a limited amount of time left, which is great because this has gone by very quickly. But we have talked, and it's mentioned a couple of times, and it was mentioned a couple of times earlier about DLT, which unfortunately I keep thinking whenever I first heard of it, it was some sort of vegan sandwich. But a DLT, we've heard about it for years. Is it really coming? And actually, have you all, in your various guises and responsibilities, taken account of it? So let's lead off with Matt on that one, if we may.
No, it's a great question. To the point, Army's point about relics or antiques, technology is sort of like a continuous curve with legacy tech, down at the bottom of the curve, sort of current, proven technology in the middle, and like emerging tech out on the tip. And, OCC found ourselves in the relic position with a legacy system. And so we wanted to bring ourselves up that curve. And the sweet spot for the most of our business is in that proven, cloud, microservices, things like that there's a lot of tools to support. But at the same time, you want a little bit exposure out at that tip, because as technology continues to prove, that what used to be emerging becomes standard, and you want to prepare yourself for that. So, we looked at DLT really from a very pragmatic perspective. I would say information, we were just talking about standardization, but information communication at its core is critical to all of our operations. And I kind of use an analogy here. I equate today's world kind of like where it used to be with CDs, right? Like a producer or a musician has to create a CD, encode the information on it, ship it to the receiver or the client. They have to open the package, open the tray, put it in, hit play to get the information out. And so it's challenging, it's expensive from the producer side, and it's, there's work involved required on the consumer side. Obviously, that's a bit of an oversimplification, but the way that we've looked at DLT is like the next evolution of that to more of a streaming model, where as a producer of data, we can just put it on the chain, and people with nodes, just like people with smart speakers, that music just automatically comes out without the customer needing to go through and do any of that unpackaging. You can just say, Alexa, play whatever, and it'll come out. And so it's about lowering that challenge of producing and sharing information. And obviously keeping everyone in sync is the goal of it, but that's kind of the way we looked at it. We're not looking at, settlement off chain or on chain, we're not looking at tokenization, things like that. It's just about how do you express information in the most efficient and effective manner.
That's important, Matt. So, as a data transmission technology, right? It's I almost say it's the ability to replicate information with certain safeguards. I think that's the way I see you are describing your at least the OCC's first view of the use of DLT. You're not focusing on the lack of trusted authority and some of the other problems that distributed ledgers are designed to solve for, and that's critical. And I think from my perspective, it's extremely important in our industry or any industry for data to move seamlessly and maintain quality, and that's a challenge that's being addressed. But we need the buy-in, right? So that's the part I think we find the hardest. It's you can build that highway, but if you don't get the right people on that highway with the right kind of rules of the road and all that in place, that doesn't work. To your question, Tim, have we looked at DLT? Yes, we've had conversations over many years, and the one challenge that we always run into in securities finance is, will people adopt, right? And the risk of build it and they will come. This is it's a hard one, right? There are not that many institutions in securities finance that can afford to make long running, never never realizing the benefits kind of investments. So I definitely think DLT has a lot of benefits. Matt, you have a very pragmatic view of it, which is great. But now the question is, how does it get adopted? Does everybody see value?
Also, I guess, to use your highway analogy, is there going to be one highway? Probably not. Inevitably, there's going to be lots of different DLTs, in my opinion. But fundamentally, to bring up the point you raised at the outset, is yes, whilst it can solve some trust elements when you've gone full committal, as it were, making that leap of faith, if I call it that, from you no longer having a ledger in your system, bank A, to having that represented, that's a massive, for a bank that has a history of what banks do in terms of safeguarding, custody, etc. In my mind, that's a massive leap of faith, and in some ways, DLT, definitely could be a solution, but it kind of goes back to the golden source question. Go on.
Yes, Phil, I think the question there becomes is how do you use DLT, right? So I look at the way Matt's presented it, is it becomes a mechanism for data transfer and data shuttling versus actually becoming the books and records for that institution. It can be the place where you've got because the ledger, it's got the quality of data in it, but in the end, every institution will make its own decision on where it stores the information, how it stores it, because a lot of securities finance data we know doesn't even stay in the securities finance systems at the end.
Yeah.
Right. The true books and records could be like a Broadridge back office, which may not be the one system that participates in stock loan transactions. So I think it's an interesting way to look at it. But to your point, right? Like, look, okay, so why are you drawing those boundaries, and are those boundaries correct? Or Phil, back to your point, maybe that's a counter proposal, right? If you're going to invest in all of this, then why do you need those other ledgers?
Well, that's it. Yeah, I mean, exactly. I think fundamentally, what are you solving for? If you're solving for operational efficiency, DLT could be it, but it doesn't have to be, right? You can solve it in different ways, and you can have better workflow. I think viewing it as a silver bullet in many ways is a gross oversimplification, and actually doesn't reflect the real world dynamic of very, very different systems, legacy issues. We saw it with SFTR amongst, pretty much every institution has a different view of every transaction to a certain extent. I mean, that's so far from a central nodal system. It's kind of, it's not true, right?
I think there's a lot of other
Yeah, no,
things
you're
we
absolutely
can do
right. It's
before we
definitely
get to
not
that.
a magic bullet. We're definitely not getting out of the business of producing CDs. You can still interact the way that you've always interacted.
Yeah.
It's just the optionality for the future.
No, but I think you're slightly.
And you do have to accompany the operational process improvements to make sure the data going onto the chain is correct.
Yeah.
That's key, right? And so we're trying to introduce some operational improvements to make sure lender and borrower agree on terms before that loan gets booked onto the chain, or agree on the new rate change before it gets booked onto the chain.
But again, that's workflow, right?
To help improve that data quality.
That can be DLT, or that can be CCP, or it can be whatever three-letter abbreviation we want to call it. That goes back to work stream, right?
Yep.
The borrower and lender agreeing, rather than have a very clunky process that kind of doesn't work effectively, having a better workflow. And that goes back to the process in my way. And
so the process connectivity and standardized data, CDM, all that kind of stuff. Yeah.
Yeah, so I basically, in my single person quest to get rid of acronyms, so AI suddenly became straight through processing, and it looks to me as though DLT is a very advanced form of straight through processing as well, in a sense, in as much as it facilitates the ability to move stuff, see stuff, and transfer stuff within a single place, which is great. We're actually coming up on our time, gentlemen. So I do want to, I'm sorry, we're going to have to skip to our last question. And if you could limit yourself to perhaps a couple of sentences each on this one. And it is, do you ever foresee a time when, this is really out there question, when human intervention for finding, borrowing, monitoring, returning, and reporting in securities finance will not be required? So who wants to get that one off?
I could say that once I agree too strongly. Finding, we don't need human intervention. Lending and borrowing, we don't need human intervention. Those functions are basically what computers and technology can do really well. But reporting, calibrating, picking the strategy for your firm, we're going to need humans at least I hope till I'm around.
What about from the banking side, Mike? What do you feel?
I think there'll always be some level of human intervention. I mean, I think the roles will change quite a bit. So to the point, trading, traders won't be traders. They'll be more technologists, adjusting algorithms, and and you could see a point where trading becomes dueling algorithms, and the person with the best algorithm wins. So I think the roles will change. Obviously, there'll be fewer. But I think we're always going to have some.
Right. Given our ages, David, as you mentioned and pointed out earlier, half of us won't be around in 40 years or so. So what do you think?
Well, first of all, I think you're significantly older than I am. So I just thought I'd get that in there.
It's not the years, it's the mileage, David.
Absolutely.
Yeah.
But I would wholeheartedly agree with Mike. I think there will be people here. There will be people doing things in some level on some role. It won't necessarily be the roles we recognize today. I don't think it's going to happen immediately. This is very much an evolutionary kind of process, not a revolutionary process. There are a lot of things I think we've come out with in our panel today where I've identified that there is either existing or soon to be existing technology, which is not perhaps at the cutting edge like DLT, but existing processes that can be applied that will be automating huge parts of our processes as we understand it today. So I think there will be people, they'll be in different roles. So I'm kind of with Mike on that.
Okay, great. Matt, what do you think?
Yeah, no, I definitely agree that there's still always going to be humans, but I think the technology can lift them up and make them more efficient. So, I know that there are lenders out there that have especially in GC, sort of predetermined rates at which they'd be willing to lend at. And when incoming borrow requests, and if it meets that rate, it just automatically executes. And that lets their traders focus on the specials and the things that really need a human touch and where there's a lot of value to the firm. And, that certainly could happen on the borrower side too. See client just covered their short, check your IMS for deliverable shares. If you don't find any, automatically generate a return. So certainly.
Excellent. Okay, and last but by no means least, Mr. Morgan.
I think tech is, as I said at the outset, it should definitely be on everyone's kind of agenda. In some ways, there's probably a degree of a tech arms race going on at the moment. Between certain, competing firms. So kind of if you're not adopting it, then maybe your future is not, you need to. But I think agree with Mike and the others. I think ultimately, we're unlikely to completely engineer humans out. I think it's going to be more in a kind of referee kind of oversight kind of function. But also, I think if you go back to that collaboration point that we've talked about a lot today, collaboration, I might be wrong, but generally works better between humans than computers currently. So to the extent that we need to collaborate, I think that's a human function. So hopefully in that regard, there'll be a few of us around for a few more.
Well, that's absolutely great. And you've just given me the end line in terms of how beautifully and wonderfully you have collaborated together on today's call, and how lucky we have been to have you all on this call today. So it's been an excellent discussion, and thank you very much. And I hope everyone on the call enjoyed it. There were a couple of questions, but I didn't want to interrupt the flow. So now with that, I will thank you very much, and I'll hand back to Gabrielle.
And I will thank you. I will thank I will thank Matt. I will thank Mike. I will thank David, and obviously Phil. I actually wrote collaborate, and I think the best way I can describe this panel was wisdom. It was less of a presentation than a real debate, and very refreshing. So thank you very much, gentlemen. I hope that the next panel we participate in. I've noticed you're all wearing the same Real Madrid shirt, or is that a white shirt? Yeah. Except for you, Tim, but you're wearing the Real Madrid shirt.
No, this is like an off-grey type of shirt here. So there we go.
Fantastic.
Bad lighting.
Thank
All right.
Gentlemen.
Thank you,
And
sir.
hope to see you soon wherever we see. Thank you.
Thank you.
So this is, for me, the closing remarks of this first North American targeted symposium from Security Finances Times. I actually, my mind was preparing what was the best panel, but they were all better, and I think over the course of the whole afternoon in London and morning in the US, we saw the number of people registering the conference growing in a way it's been pretty surprising. So I can't give the exact numbers, take or leave a million, but I think they've been pretty successful. Again, I want to thank the organizers, Securities Financing, Security Finance Times. I want to again thank Event Rock for making this so seamless and so professional. And we would like to thank all the sponsors, including Market Access, who is our platinum sponsors. So thank you very much. Hope to see you very soon. And I think we can close the debate. Looking around, a beautiful view here.